Stop scrolling right now because what I am about to show you is vault data that tells you exactly what is happening in the physical precious metals market. And it is data that most retail investors never see. The headlines talk about price. They talk about charts. They talk about technical patterns. But they never talk about what is actually happening inside the vaults. They never show you how much metal is leaving. They never explain why that matters. And they certainly never connect the dots between shrinking inventories and what that means for the price you see on your screen. Today, I am going to show you the actual numbers, not speculation, not conspiracy theories, real data published by the CME itself. And by the time you finish this video, you are going to understand why silver is flashing warning signs that we have not seen in over a decade, why gold just entered what major institutions are calling a structural repricing phase, why the 50 million ounce level in silver registered inventory is the number everyone should be watching, and why the combination of backwardation, vault outflows, and record prices creates what one analyst called a perfect storm for precious metals in 2026. Before we get into the data, I want to know where you are watching from. Drop a comment right now and tell me your country or your city. I see viewers from all over the world on this channel, and I want to know how global this audience really is. Whether you are in the United States, Canada, the United Kingdom, India, Australia, Germany, Singapore, South Africa, Japan, wherever you are watching from, type it in the comments. I read every single one, and it helps me understand who is in this community and what kind of content you want to see. Also, if you have been watching these videos and you have not subscribed yet, take 1 second and hit that button. It costs you nothing and it helps the channel grow so I can keep making this content. All right, let us get into the data that matters. Let me start with the most important concept you need to understand about the COMEX. When you hear that silver or gold was delivered on the exchange, most people assume that means the metal left the building, that someone backed up a truck and drove away with bars. But that is not what delivery means at COMEX. Delivery on COMEX means that ownership of metal changed hands within the vault system. The metal stays in the vault. It just gets reassigned from one owner to another. The owner changes. The location does not. This is an important distinction because it means you can have massive delivery volume without any metal actually leaving the system. And for years, that is exactly what happened. Metal got delivered, ownership changed, but the metal stayed in place. Everyone was happy to leave their bars in the vault and just trade the paper claims on top of them. But something changed, and the data shows it clearly. Metal is now leaving the vaults, not just changing ownership inside the vault, actually leaving, being loaded onto trucks, being shipped to refiners, being sent to Asia, disappearing from the COMEX system entirely. And once it leaves, it does not come back easily, because the people taking delivery and removing metal are not speculators who will flip it next month. They are industrial users who need it for production. They are investors who want it in their own custody. They are sovereign entities building strategic reserves. They are taking the metal out because they want the metal, not the paper claim, the actual physical bars. Let me show you what this looks like in the silver market specifically. Since September of last year, there has been a massive drawdown in registered supplies. Registered metal is the silver that has been certified by the exchange as eligible for delivery against futures contracts. This is the metal that shorts can use to fulfill their obligations. This is the metal that the entire futures market relies on to maintain credibility, and it is shrinking rapidly. The chart shows a consistent downward trend, not a temporary dip, not a seasonal adjustment, a structural decline in the metal available for delivery. Every month, less registered silver is in the vaults than the month before, and it is not just moving from registered to eligible. Eligible inventory, which is metal stored in the vaults but not certified for delivery, is also seeing outflows. The metal is leaving the system entirely. Here is the number that should concern you. If registered silver falls below 50 million ounces, COMEX physical supplies will start to be extremely strained. We are not at 50 million yet, but we are heading in that direction, and the pace of decline suggests we could reach that critical level within the next several months if current trends continue. Now let me ask you a question. If you owned a futures contract that gave you the right to take delivery of 5,000 ounces of silver, and you looked at the registered inventory and saw it was approaching critical levels, what would you do? Would you roll your contract forward and trust that the metal will be there when you eventually want it? Or would you stand for delivery now while you still can? More and more participants are choosing option 2. They are standing for delivery. They are taking the metal, and they are removing it from the vaults. This brings me to the single most important market signal in silver right now: backwardation. If you do not understand what backwardation means, you need to learn it today because it tells you everything about the state of the physical market. In a normal commodity market, futures prices are higher than spot prices. This is called contango. It makes sense intuitively. If you are buying a contract for delivery 3 months from now, you expect to pay a little more than the current spot price because you are paying for storage, insurance, and the time value of money. Contango is normal. Contango is healthy. Contango suggests the market is well supplied and functioning properly. Backwardation is the opposite. Backwardation means spot prices are higher than futures prices. The market is willing to pay more for metal right now than for metal delivered later. Think about what that implies. It implies urgency. It implies scarcity. It implies that buyers do not trust that the metal will be available later at a reasonable price, so they are willing to pay a premium to secure it immediately. Silver is currently in backwardation. The spot price is trading above the futures price by about 10 cents per ounce. Now, 10 cents might not sound like much, but in commodity markets, the direction matters more than the magnitude. The fact that we are in backwardation at all tells you the physical market is under stress. Buyers want the metal now. They do not want promises of metal later. They want it in their hands today. But now, that trade is reversing. The gold that flowed into COMEX last year is flowing back out. In the latest month, registered gold saw a significant decline, and the metal did not just move from registered to eligible. It left the vault entirely. This shows sustained physical demand for gold even at prices above $5,000 per ounce. So let me paint the picture. Silver is in backwardation, suggesting immediate physical stress. Gold is seeing outflows after the arbitrage trade reverses. Both metals are seeing registered inventory decline. Both metals are seeing sustained delivery demand. And both metals are at or near record high prices. This combination is extremely unusual. Normally, high prices reduce demand. High prices cause people to sell, to take profits, to wait for a pullback. But that is not happening. Demand is persisting through record prices. What does that tell you about the conviction of the buyers? Let me give you some specific numbers on silver deliveries because this puts the demand in context. February was a minor delivery month for silver, not one of the big months where everyone expects heavy activity, just a regular minor month. And almost $2 billion worth of silver was delivered. $2 billion in a minor month. That is not normal. That is not what you see in a market with comfortable supply. That is what you see in a market where participants are aggressively securing physical metal. And here is where it gets really interesting. While silver is in backwardation, gold is in the opposite situation. Gold futures are trading above spot. This created a massive arbitrage opportunity in 2025 where traders could buy gold in London at the spot price, ship it to New York, and sell it into the futures market at a higher price. That arbitrage caused huge amounts of gold to flow from London to New York. COMEX gold inventories exploded higher. Compared to February of last year, this February saw stronger delivery activity, and last year was already elevated compared to historical norms. So we are seeing elevated delivery on top of already elevated delivery. The trend is accelerating, not decelerating. Now I want to zoom out and talk about what is happening in gold because gold just crossed a threshold that changes everything. Gold is now trading above $5,000 per ounce. As of the latest data, spot gold is around $51.86. And according to Motilal Oswal Financial Services, this is not just another rally. This is the beginning of what they call a structural repricing phase, a new supercycle. What is a supercycle? It is a period of sustained price appreciation driven by fundamental shifts in supply, demand, or monetary conditions. Not a cyclical bounce, not a technical rally, a multi-year structural move higher caused by forces that do not reverse easily. According to their analysis, gold could reach $6,000 within the next 12 months. And if geopolitical and fiscal pressures intensify, the medium-term target is $7,500. Let me repeat that. $6,000 in 12 months, $7,500 in the medium term. From a major financial services firm, not from a gold bug on the internet. From institutional analysts with billions of dollars in assets under management. And they are not alone. JP Morgan is targeting $6,300 by the end of 2026. Goldman Sachs is targeting $5,400. Bank of America sees a path to $6,000 within 12 months. UBS projects around $6,200. BMO Securities suggests a bull case scenario near $6,500. The consensus among major institutions is that gold is going significantly higher from here. Now I want to address something that I think confuses a lot of people. If interest rates are high, should gold not be falling? Traditionally, yes, gold pays no interest. So when real interest rates are positive, there is an opportunity cost to holding gold instead of bonds or other yielding assets. Between 2023 and 2025, we had periods of positive real interest rates. And during those periods, gold should have retreated according to traditional models. But it did not retreat. It kept going higher. Why? Because something more fundamental is driving this rally than interest rate differentials. According to the analysis, investors are no longer just hedging inflation. They are expressing concern about mounting global debt levels and the long-term viability of fiscal and monetary frameworks. In plain English, they do not trust the system anymore. This is what the analysts call a monetary trust deficit. Trust in traditional financial systems is eroding. Central banks have printed trillions of dollars. Government debt levels are at historic highs. Fiscal trajectories look unsustainable. And investors are responding by moving into assets that cannot be printed or defaulted on. Gold is the obvious choice. It has served as money for thousands of years. It has no counterparty risk. It cannot be inflated away by a central bank decision. And increasingly, it is being treated not as a speculative hedge, but as a structural portfolio allocation. Central banks themselves are the biggest evidence of this shift. They are buying over 1,000 tons of gold annually, not selling, buying, and they are doing it consistently year after year. These are the institutions that manage currency reserves. These are the people who understand monetary systems better than anyone, and they are accumulating gold at a pace we have not seen in decades. What do they know that the average investor does not? Now let me connect this back to silver, because I think the gold story tells you where silver is going. Silver and gold are related but not identical. Gold moves first, gold leads, then silver follows. And when silver follows, it typically outperforms on a percentage basis because it is a smaller market with more volatility. If gold is entering a structural repricing phase driven by monetary trust deficits, what happens to silver? Silver has all the same monetary characteristics as gold. It has been money for thousands of years. It has no counterparty risk. It cannot be printed. But silver also has industrial demand that gold does not have. Silver is used in solar panels, electronics, electric vehicles, medical devices, and increasingly in AI infrastructure. That industrial demand provides a floor under the price even if investment demand temporarily fades. So silver has the monetary tailwind from the same forces driving gold, plus the industrial tailwind from secular growth trends in clean energy and technology, plus the supply constraints from 6 consecutive years of deficit, plus the physical market stress evidenced by backwardation and vault outflows. This is what the analyst meant when they called it a perfect storm for silver. Let me ask you another question because I want to understand how you think about this. When you see gold above $5,000 and silver approaching $90, what is your instinct? Do you think the move is overdone and due for a correction? Or do you think we are still early in a much larger move? Drop your answer in the comments. I am genuinely curious how this audience is positioned mentally. Now let me talk about what I am watching over the coming weeks, because these are the data points that will tell us whether the trends continue or reverse. First, the registered inventory level in silver. We need to watch whether the drawdown continues and how fast we approach the 50 million ounce threshold. Below 50 million ounces, the math gets very uncomfortable. The outstanding futures contracts would represent a multiple of the available physical supply that creates genuine delivery risk. Second, the backwardation in silver. Is it persisting or is it closing? If backwardation persists or widens, it confirms ongoing physical stress. If it closes and we return to contango, it suggests supply is finding its way to the market and pressure is easing. Third, the gold outflows from COMEX. The arbitrage trade is reversing. How much more gold leaves the vaults? Where does it go? If gold continues to leave despite record high prices, it confirms that holders value the metal more than the profit from selling. Fourth, the delivery volume in March. March is a major delivery month for silver. How many contracts stand for delivery versus rolling forward? If March delivery volume exceeds expectations, it confirms the trend of increasing physical demand. Fifth, the institutional forecasts. Are more banks raising their targets? Are any banks getting bearish? The consensus right now is overwhelmingly bullish, but consensus can shift. Watching for any cracks in the bull case helps manage risk. Let me share a framework that helps me think about situations like this. When you see vault inventories declining, you have to ask why. There are only a few possible explanations. 1. Demand is exceeding supply and inventories are being drawn down to fill the gap. 2. Holders are losing confidence in the custody system and removing metal. 3. Metal is flowing to regions with higher premiums through arbitrage. All three explanations are bullish for price. None of them suggest weakness in physical demand. When you see backwardation, you have to ask what it means. Backwardation means buyers are paying more for immediate delivery than for future delivery. It means urgency. It means the market does not trust that supply will be available later at today's price. It is one of the clearest signals of physical stress that exists in commodity markets. And we are seeing it in silver right now. When you see sustained demand through record high prices, you have to ask who is buying. Speculative demand typically fades when prices get expensive. Speculators take profits. They rotate to other opportunities. They wait for pullbacks. But structural demand from industrial users and strategic accumulators does not fade with price. They need the metal, they secure the metal, and they are not selling it back. Now I want to address something that I think holds a lot of people back from positioning appropriately: the fear of buying at the top. When gold is at $5,000 and silver is near $90, the natural instinct is to think you missed the move. You look at where prices were a year ago or 5 years ago, and you feel like you are late. You wonder if this is the top. You hesitate. Here is what I want you to consider. If the analysts are right about the structural repricing phase, if $6,000 gold and $7,500 gold are coming, then $5,000 gold is not the top. It is a waypoint. It is the beginning of a new phase, not the end of an old one. The same logic applies to silver. If gold goes from $5,000 to $7,500, that is a 50% increase. If silver outperforms gold as it typically does in bull markets, silver could more than double from current levels. I'm not saying there will not be pullbacks. There will be. Precious metals do not go up in a straight line. They rally, they correct, they consolidate, they rally again. The volatility is part of the process, but volatility within a bull market is different from a trend reversal. And right now, nothing in the data suggests the trend is reversing. Everything suggests the trend is accelerating. Let me talk about the difference between paper and physical, because this distinction matters more now than ever. When you buy a futures contract or an ETF share, you own a paper claim on metal. That claim is only as good as the counterparty behind it. If the counterparty cannot deliver, your paper claim becomes worthless. For most of modern history, this was not a concern. The system worked. Paper and physical were fungible. You could convert one to the other at will. But when registered inventories drop to critical levels, when backwardation appears, when metal is flowing out of Western vaults to Eastern destinations, the fungibility of paper and physical comes into question. Can you actually convert your paper claim to physical metal when you want to? At what price? With what delay? These are questions that did not matter when inventories were comfortable. They matter now. I am not telling you to sell all your paper holdings and buy only physical. That is a decision each person has to make based on their own situation. But I am telling you to understand the distinction, to recognize that paper exposure carries counterparty risk that physical does not, and to factor that risk into your positioning, especially as the physical market tightens. Here's something else to consider. The people who have access to the best data, the people who see the vault numbers daily, the people who understand the delivery mechanics intimately, what are they doing? The answer is they are taking delivery. They are removing metal from the vaults. They are securing physical supply. Their actions tell you what they believe, even if their words are more measured. Now let me zoom out one more time and put this in the context of what is happening in the global economy. We are living through a period of unprecedented monetary and fiscal experimentation. Central banks printed trillions of dollars in response to the pandemic. Government debt levels are at historic highs relative to GDP. Interest payments on that debt are becoming a larger share of government budgets. And yet markets continue to function, currencies continue to trade, and the system continues to hold together. But for how long? That is the question gold buyers are asking. Not today, not tomorrow. But over the next 5 or 10 years, what happens to a monetary system built on debt that cannot be repaid in real terms? What happens to currencies that are being debased to manage that debt? What happens to purchasing power? What happens to trust? Gold and silver are answers to those questions. They are alternatives to a system that many people no longer trust. They are insurance against outcomes that are unlikely but catastrophic. And as more people ask those questions, as more institutions position for those outcomes, demand for physical metal increases. Supply does not increase proportionally because mining capacity cannot scale quickly, and price adjusts to balance the imbalance. This is the dynamic we are living through. This is what the data shows. This is why vault inventories are declining despite record high prices. This is why backwardation persists. This is why major institutions are targeting $6,000 gold and higher. The structural forces are aligned in a way that supports sustained price appreciation. Now, I want to close with some questions for you. First, what is your gold price target for the end of 2026? Do you agree with the institutional consensus of $6,000 plus, or do you think they are too bullish? Second, what is your silver price target? If gold hits $6,000, where does silver go? $100, $150, higher. Third, are you positioned in paper or physical or both? What percentage of your precious metals exposure is actual metal in your custody versus paper claims? Drop your answers in the comments. I want to see how this community thinks about these questions. And tell me what other topics you want me to cover in future videos. I am here to provide the analysis and data that helps you make informed decisions. The vault data is telling a story. The story is that physical demand is overwhelming supply at the exchange level. The story is that metal is leaving the Western system and flowing east. The story is that participants are choosing physical over paper in increasing numbers. And the story is that the perfect storm for precious metals may have already begun. Watch the registered inventory numbers. Watch the backwardation. Watch the delivery volumes. Watch the institutional positioning. These are the signals that tell you what is actually happening beneath the price action that everyone else watches. Stay informed, stay positioned, and do not let a pullback shake you out of a position that the fundamental data supports. The biggest moves in precious metals happen when most people are not paying attention or have given up. Do not be most people. Make sure you subscribe if you have not already. Hit the notification bell so you do not miss the next update. And drop a comment letting me know where you are watching from and what you think happens next. I will see you in the next video.